Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to manage your Forex PL, your profit and loss in your trading. When we're looking at trading, sometimes we're not really thinking about our P&L. What we're thinking about is how much money we're going to make. And that's sort of the kiss of death, because once you start trading for dollars, you get emotionally involved in things. Oh my God, that's a pizza, or if you're trading on a larger scale, maybe that's maybe that's a car. So you have to take the dollar out of it, but you can't take the P&L out of it because you use your past trading record, your trading metrics, to make reasonable determinations of how much money is a percent against the amount of money in your bank that you're going to be able to make at the end of the year. So let's say that you're just getting started and 20-30% against your money is a target goal, and that's maybe reasonable for you. Maybe you're a more experienced trader and you've had 60%. I don't know. I can't tell you how much you can make. Maybe you're going to go broke. But that's the way that we work with probabilities, is that it's a percentage of opportunity that you're going to be able to take advantage of. So if you're getting started and your goal is a 20%, let's say, and you're trading a one full lot, you need about $10,000 to do that today, because at 5% of the cash value for U.S. margin requirements, you need about $6,600 just in margin to trade that one lot. So if you're trading three full lots, you'd need about, say, $7,300. You need about that much money, 21, to trade those three lots just in margin. So you've got to have some runway built in there. So I always base things on the even numbers: 10,000 to trade one full lot, 100,000 to trade 10. So let's say you're working with a one full lot. You're just coming out of a training period, a working period where you're establishing your consistency, your ability to be consistent in trading. And during that period of time, you see that you're going to probably be able to make about $2,000 a year on that $10,000 account, 20%. So that's a target. Now you go ahead and break that target down into what you should expect to be able to make on how many times you trade. And you've got 200 trading days a year. And so you backtrack through all of your numbers and days available to trade, and hours that you're going to be able to trade, and how many times a day you're going to be able to. You can just go work all that math out to finally come to the conclusion to say, yes, it's reasonable for me to have that 20% a year or 60% a year target. So do the rules that I have facilitate that? Because your outcome is dependent on every trade that you make. In the last, let's see, 5 days, I don't remember exactly what all I've had, but I did a 0.3%, an 0.8%, a 1.2%, lost 1.3%, gained 1.4%, lost 2%, gained 3%. That's kind of a trail. The numbers aren't quite right. And then the other day I just lost, yesterday I lost 3.3%, which is kind of a large percent to take. If I'm going to be losing, when I lose 1.25% to 3.5% or 4% or something like that, those are hard to make up. And so instead of trying to force the positions by making more pips or putting more money in to the account to trade more lots before you're really ready to do that, you really have to back off and say, well, that's not the problem. Managing the PL is not going to be satisfied by adding more lots or looking for more pips on the trade. There's a flaw in what I'm doing, and that flaw is a 90% probability that it's within the constraints of your entry analysis. not in the position management. If you can get into position management fairly regularly, you'll learn how to stay profitable once you get into the position management. You may not want to follow the specific rules for shortening up your stop and taking a risk of getting tapped out at break even, as you should do. And I didn't do that the other day, and that was my 3% loss. I just let it go, and I thought, well, it'll come back. You know, that sad song, it'll come back. And it didn't come back, and I finally cut it at 3.2%. Just said, fuck this. I don't want to trade anymore today. But we're 14 days into the month. This is May of 2025, and even with that loss, I'm still up overall about 6.5% for the month. I'm about halfway through. The big hit was warranted because of the management of my P&L that I do, that says, oh, I was up 9%, a little over 9% for the month in about the 10th of the month, and then off we go with this big 3.5% or 3.25% drop. So I said, well, I've got the earnings there, that if I take a big hit, if this thing doesn't come back, I'll cut it, maybe at a 5% loss to prove itself out. I don't know. But when you're looking for making the big moves, you have to broaden out your risk profile a little bit. There was a lot of volatility. I was in a little late to the game. I was up about 1.25% for the day, a little less than 1.25% against my risk for the day. And then I went in. I wanted to push it and take it because the volatility was there. I went in and got my trade. It triggered, and it didn't do anything. And what I should have done is I should have got out with a 0.3% loss against my bank, but I didn't. I hung in there. I went out to get a sandwich for lunch, and I came back in, and I'm 2% underwater. And I, because I didn't stop out, because I have other things that I'm doing when I'm sitting there at the trading desk. I've got my finger on the get out button. I know when to get out, and so this time I should have set the stop, but because it was floating so close to that volatility level, I knew that even if you put the stop where it would normally be in a thing like that, so you could get out with less loss, that's where everybody else's stop is, and eventually some institutional trader is going to come along and go, oh, well, I can grab that, and it's just order flow that they're grabbing. They're not stop on you. They're just satisfying their client orders, and you happen to be in the way. So you only have yourself to blame when that happens. And I didn't want to lose my position, because I felt very strongly that I could get at least another 0.5%, if not a full percent, and have a 1.75% to 2% day. So instead, I turned around and I lost 3.2% on that. So the managing of the PL is not only on a per trade basis, but you also have to look at, when I'm looking at that kind of thing, I'm looking at the month to date activity. Where have I been for the month? If I've been on all cylinders and hitting pretty good, and my PL is really good for that month to that date, and of course the number of days, I can't just be 3% up and have traded 2 days. That doesn't float. Yeah, again, you'd have to look back into the previous month and see the continuation, because eventually, if you're an active trader, you know that statistically you're going to hit 6 losers in a row. You don't want one of those losers to be a 5%er, and then you go back in there and you drop another 3%. You're 8% down. That could be 2 months of trading for you in order to make up. So you have to be mindful that tracking your PL is not tracking the profits to say how marvelously a good trader you are, but it's to keep your expectations in check and in line with your original, I think I can get 20% a year with my trading skills that I have. Again, I'm just using 20%. I can show you the numbers on how to make 130% a year without large leverage, but you have to be reasonable when you're starting out. If you could make If all things go to shit for you, you should be able to make 20% on your money. I mean, I'm just saying that based on the capabilities of the market and your ability to trade it, you should be able to make at least what you could make in real estate, because it's a little more risky than real estate, and so your reward should be greater. If you can't get more than 20% a year on trading Forex, then you should not be trading Forex. You should trade another financial vehicle. And so the logical conclusion to that is, well, Peter, if 20% is the floor, how much could I make? I don't know. Well, I don't know. If you're reasonable in your expectations, you should be able to make large single-digit return. If you're really good, you might have some 10%, or I've had 20% months where I've traded. So what's possible is anything. It's also possible to lose everything in one trade. So if you're not cognizant of your P&L, you're not trading for the P&L, you're managing your positions and your risk based on the success or lack of success of your P&L. If your P&L is down for the month in comparison to where it normally should be, you have to take a little bit less aggressive position. You might not be feeling good. Maybe your dog pooped on the floor and it's upset you emotionally, or you lost your job or whatever. That doesn't go away in 42 seconds. So you shouldn't be trading during those periods of duress unless you are trained to do that. And even then, you probably should just pass. If you've got a good track record and you know you're going to make money at the end of the year, that you're flushing the cash register positive every month, what do you worry about if you're not going to trade for a week while you regain your sanity? Doesn't make any sense to push against your P&L when you're not in your top form. Or if you've lost 2 or 3 times in a row, what are you going to do? You're going to risk, oh, there's the big opportunity. I only get those big opportunities 4 times a year. I'm going to push it all to the center of the table. That's after you've lost 3 or 4 times straight in a row. Are you in a statistical downturn? It doesn't make any difference. You have a statistically high probability that you're going to lose again, because at some point you're going to lose 6 times in a row. Well, you're going to win 6 times in a row too. But that's great. You're going to win 6 times in a row and you're going to clap your hands and everything's going to be great. But when you lose 6 times in a row, if that takes your account to the wood, then you're not so happy. So managing your risk, peeling that onion back and looking at the details of managing your risk, one of the components of managing your risk is understanding how to use your P&L to manage that risk. Okay, well, I think that pretty well sums up my desire of information to give to you, is that we all understand that risk management is at the forefront of our trading safety. But there are many components to risk management, many different rules for the risk management. If those rules are sporadic and non-sequential, then you've got a mess on your hands. That's why I rely on the life cycle of a currency position, entry analysis, position management, and exit methodology. The life cycle of a currency position I developed and named it about 10 years ago. And it's based on my 33-year career as a senior software engineer, designing really complex business computer applications, where you use the software development lifecycle. The software development lifecycle is a process of breaking a complex problem down into smaller problems that are sequentially oriented and solving each problem, and then working on the communication between those solutions so that you get transition from solution set to solution set. It's the same thing in currency trading. Same thing, learn how to drive a car. It's the same. It's nothing special. Learn how to play guitar. It's the same thing. You have to have a process. And so part of your risk management process that I work with in students, and it's the most difficult thing because they're bad habits that people develop. And so the fast track course, that's my primary vehicle for working with folks, is that the emphasis is on risk management. Although you're not in your face all day long, risk management, it's there. It's implicit in the process, because the last thing you want to do is try to figure out risk management in real time under the pressure of volatile price action. You've got to have all that stuff set out in a rule. Oh, I'm in my position management and the volatility is going crazy and blah, 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 blah. You got to have a rule that when that volatility starts, this is what you should do. Did this happen or did this happen? If so, get out. Get out then. Take what you've got. If this happened, this isn't going on and this isn't going on, well, then you're okay. Stay with the volatility. It's not as dramatic as your rule would require it to be for you to exit at that particular time. So that's all risk management, but it's embedded in the course as you go along, so that by the time you get done the end of the course, you never have to think about risk management again, because you've already constructed your rules. I've worked with you to construct your rules so that that risk management is in there. If you know that you're impatient and you're this and you're that, then why would you want to try to have us swing that training to go from the day trading environment where we put all these pieces together to do long-term position trading? Why would you want to do that? Because that's not in your risk management profile as a trader, as a person. That's why it's so important that I work personally with the student. I just don't send a PDF file. I mean, I've got a PDF file I can send you for free. It's 7 steps to success in Forex trading. It goes over 7 issues that I've met in my trading background many years ago as I was coming up through and getting stumbled and getting banged up with each one of these things. Each one of the things that I mentioned cost me tens of thousands of dollars to learn how to identify, much less solve it. So it might be instructive for you to read those things and say, yeah, I've experienced that, I've experienced that, I've experienced this, or oh, I didn't experience that. What's that all about? And then if you want to have an email conference with me or a video conference, we can talk, and maybe I can help you with that. I'm not going to try to force you to take a course. I don't have the bandwidth or the time. There's only one of me, and I only want to work with a few people at a time so that I can enjoy my retirement and do my trading without worrying about what Frank is doing with his trading. So the fast track course enables me to put the person on a really strong foundation of development so that at the end of that period of time, how to manage your PL is just an intrinsic part of the process of your trading. That's really what I guess what I'm getting down to is this management of your PL is not the way that the folks out in video land are teaching you what to do with your PL. All they say is don't trade your PL. No. Don't trade your PL from the dollar standpoint and how greedy you are, but you must incorporate the management of your P&L into the rules that you have for risk management. The management of the PL is a fluid process, but it has to interact with a more static rule. You're feeding it different information and it's going to spit back different values for you as to what you should do based on the variability of that PL. The rule will show you how to get out of that. If you're in a 6-period drawdown, this is what you should do until you stop being in a 6-period drawdown. How do you know when you're in a 6-period drawdown until you have been hit with six hits? Well, you don't. And so that's got to be on the forefront of your mind. Every trade that you take could be the start of a 6-period drawdown. But you also have to diabolically, on the other side of your head, take the other side of that and say, this could be the start of a six winners in a row for me. And so I got to really watch. I got to really watch for that opportunity where I can shoot the potatoes and push all my chips to the center of the table. Correspondingly, you better be watching for that planet killer trade that will take your account in that one trade if you don't follow your rules of risk management, of which managing your PL is part of, but managing the PL is not massaging it to make more money. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.